let's talk about where you should exit a trade like a pro, so you don't get like stopped out. Like price is this close to hit your take profit, but it goes all the way and stops you out. And personally think a lot of the times it happens because we have these traders that are delusional high RR trader. Like what I mean by that is that they are delusional of the risk score ratio. They want they want a 1 to 20 risk score ratio trade. And most of the time, what happens is that, let's say they get a 1 to 2 risk reward ratio trade. Okay, their TP hits and it's a 1 to 2 risk reward ratio. They hold their position. They don't want to close their position. Why? Because they think that the price is gonna go all the way, like it's gonna just go and hit their like 1 to 20 risk reward ratio trade, take profit. That's not gonna happen. That's a lot of you guys might have the problem where you get stopped out and because you're this high RR like trader, like delusional trader. You know what I mean by that. So I'm gonna show you guys where you can put your take profit so that that never happens to you. And I always go for a 1 to 1. Like most of the time, not a 1 to 1. If there is not a setup and I think like that, this is the only take profit, the only price area that I think that the price is gonna go and hit. That's I even put my like trade as a 1 to 1 risk reward ratio trade. So a 1 to 1 risk reward ratio is better than losing a trade. And I always personally go for a 1 to 2, 1 to 3, or 1 to 1 risk reward ratio trade. And it depends where the area that I want and the price wants to go and take that out. I put my take profit there. So let me show you guys where you can put your take profit, and these areas are 100% correct and the price always wants to take that out. So let's go on the chart and I want to show you guys few stuff. So we are currently on a 50-minute time frame. Just for today, let's see this. The New York Exchange Market open. So let's say that we are currently trading on a higher time frame. So as you guys can see, look, we made a high, then a low, we broke 5-minute structure, price did come into this, fell into this fair value gap, boom, we marked this fair value gap. So let's say that, it's just an example, let's say that we enter position over here, just on the bottom of this candle, because this is where the price closed out of that fair value gap, put my stop loss above there. So now, you would be thinking where you want to put your take profit. I know a lot of you guys might just go on a higher time frame, like let's say go on an hourly time frame, like say, oh, it's gonna at least this is gonna be my final take profit down here, a 1 to 4 risk reward ratio trade. I know a lot of you guys might do this, and you personally think that this is gonna come all the way, the price is gonna come all the way down here to take out like these low. You might get lucky sometimes, but most of the time that's not gonna happen. So where is the right place to put your take profit? So since we took this trade on a higher time frame, which was on a 50-minute, so I want to put my take profit, at least my first take profit would be this. Just these low down here. This would be my first take profit. Why? Because price is 100% want to come and wants to take out these. Or let's say that we have like this 50-minute low over here, this liquidity over there, and that hasn't been taken out. So this is gonna be most likely my second take profit. Why? Because there is for sure the price wants to come and take out these 50-minute low, or sweep out, take out this 50-minute low to just price in order for price to go higher. So keep this in mind. There are only 4 places where the price is drawn into. So there's a lot of like places where you can put your take profit, but most important one of it is where the liquidity is, because market always wants to go and take out liquidity. So you want to put your take profit based on the area that the liquidity needs to be taken out. So on this example over here, on this short over here, that would be this low over here. Why? Because this low already has been taken out. So let's say if we took this trade before it hitting, coming like down here, and this should be another example for you guys. Let's talk about this. Now I'm talking on a higher time frame. So if you take your trades on a 50-minute time frame, you can put your take profit based on a 50-minute time frame or hourly time frame. You can go and put your take profit based on the daily time frame or the weekly time frame. So let's talk about this one over here. So this was before the market opened. We have this order block. Look, price come, fell into this order block. Okay, we close below that. Let's say that if we enter a position over here, our stop loss was just above this high. Where would we put our take profit? The first thing you have to do is look out for 50-minute liquidities that hasn't been taken out. We do have these, but then we have these. So personally, this would have been my final take profit because it would give me a good risk reward ratio, like a 1.6. And as you guys can see, what happened? Price did come, took out this liquidity. Now it's going higher. It's going higher. So let's say if you had put your take profit based on the hourly time frame down here, what would happen most of the time? You could have a good trade over here, a 1.5 risk reward ratio trade. Your TP would have been hit. You would have been done for the day. You would be happy. You took a W today. But let's say your take profit is down here. What happens is that, like, this price might go and stop you out. Why? Because we took out this 50-minute low and we took out these low over here. Then for sure we swept liquidity, because once we swept the liquidity, the price wants to go higher, maybe fill another fair value gap, or wants to come all the way back here to take out this high or this high over there. So keep that in mind. So if you go on the 1-minute time frame, because I take my trades personally on 1-minute time frame, and yeah. So if you take your trades on 1-minute time frame, I want you to put your take profit based on a 5-minute and the 1-minute time frame, or sometimes a 50-minute also. You could do that. Then, so let's talk about few stuff. Let's just mark the market open for today, which was around here. Market open. So let's say that we took this trade on 1-minute time frame, and there is few stuff that I want to explain to you guys. So let's go on hourly time. So we saw a liquidity sweep on the pre-market, which got this high, and we came into this hourly order block, filled this fair value gap. We want to scale down on the 50-minute time frame. So we saw disrespect of this fair value gap, this bullish fair value gap over here. So we disrespected that with this candle, and let's go on the 1-minute time frame. So let me just mark that fair value gap so that we know where it was. These 1-minute time frame. Boom, we disrespected that over here. Now look, so we could have entered this trade. So there was news. I did not take this trade, no trade today, because we had news, and it really didn't give any kind of like this was the news. It didn't give any kind of setup for me. There was this setup before the news. What happens? Look, we did have this fair order block, 1 minute. Boom. Bruh, what the heck? This 1 minute order block, boom, it gets filled. We got a close out of it. I could have entered a trade over here, or I could have just waited for it to be show more bearish confluence to the downside, my stop loss would have been here. So now where would have been my take profit? Since I took this trade on 1 minute time frame, the first thing I would do is go on a 5 minute time frame and look where there is a liquidity that hasn't been taken out. So if we look at closely, we do have this 5 minute low over here, and then we have these 5 minute lows over here, this 5 minute liquidity that hasn't been taken out, and my take profit would have been these low over here, this liquidity over here. Boom. And as you guys can see, it had given me only a 1-to-1 risk reward ratio trade. And if you're wondering why I wouldn't put it like, let's see that if like I would have gone on a hourly time frame, put my take profit down here, would have given me a 1-to-3 risk reward ratio trade. Why? Because I took my trade on 1 minute time frame, and my confidence was based on the 1 minute time frame, the lower time frame, and price could just, by just sweeping the 5 minute liquidity, it could go higher. So understand, you want to put your take profit based on, first thing you would have to put your take profit based on is the liquidity, bro. Look where the liquidity is, where drawn the liquidity is, where the market, because markets wants to take out liquidity, because that happens, bro. Liquidity is the most important thing, bro. Let me show you guys just a few examples on the hourly. Look over here. Boom, we have this hourly high. What happened? Market come, took out this high, went lower, we saw reaction to the downside. What happened again? It came all the way up here and took out this high, and also I think this is news, filled into this hourly fair value again. For the first important thing would be the liquidity. You wanted to put it based on the liquidity, and you can see over here what happened. We have this bearish liquidity to the downside over here. Market came, took out this low, with a reaction to the upside. Markets always chase liquidity, and that's where you put your take profit. And don't be a delusional high RR trader, like risk reward ratio. You want a 1-to-100 risk reward ratio trade. And the second place you have to put is fair value gaps, because market wants to fill the fair value gap. So let's say that if you see that, okay, you have a good risk reward ratio trade, it's a 1-to-3, but the liquidity is like maybe all the way down here, and you think the market, there's impossible for the market to come and take out that, you just have to put it based on the fair value gap, just like look, we have a fair value gap over here, market came and filled this completely. You understand me? So either you put on a fair value gap or a liquidity, sometimes mark the equilibrium, put there, but liquidity is the main point where you should put your take profit as. And don't be this delusional high RR risk reward ratio trade. As I said, if you take your trade on hourly, good, you could put your take profit on based on a 4-hour. But if you take your trades based on 5 minute, put it on based on 50 minute, sometimes hourly. But if you take your trade based on a 1 minute time frame, don't go and put your take profit based on a 4-hour liquidity, because that's not gonna happen. You should put it just based on a 5 minute, 15 minute only. So I hope this video helps you, for you to like where put your take profit. But if you have any kind of question, let me know in the comments, and I will try to explain it better. I'm not that good at explaining things, but I try my best. I hope this video helps you guys. But yeah, see you guys on the next video.